The hidden mechanics behind big tech's exponential growth, a grand scheme unveiled. The meteoric rise of big tech corporations on Wall Street has been celebrated as a triumph of innovation and capitalism. However, beneath the surface lies a complex web of financial manipulation and political influence, orchestrated by a handful of powerful entities. This essay investigates how the Federal Reserve's monetary policies, major financial institutions, and entrenched elite families have contributed to this phenomenon, turning Wall Street into a precarious bubble that threatens economic stability. The role of the Federal Reserve in monetary policy. The Federal Reserve, Fed, as the central bank of the United States, wields immense power over the economy through its control of monetary policy. Since the 2008 financial crisis, the Fed has engaged in aggressive quantitative easing, QE, injecting trillions of dollars into the financial system. While QE was ostensibly designed to stimulate the economy, much of this newly created money found its way into financial markets, driving asset prices to unprecedented heights. Financial giants such as BlackRock, State Street, Vanguard, J.P. Morgan, and Goldman Sachs acted as conduits for this liquidity. These institutions funneled billions into big tech stocks, inflating their valuations far beyond traditional metrics like earnings or revenue growth. For instance, during the COVID-19 pandemic, the combined market capitalization of companies like Amazon, Apple, Google, and Microsoft soared by trillions of dollars, even as the broader economy faced significant contraction. The herd mentality of retail investors. The actions of these financial behemoths created a domino effect. Retail investors, lured by the promise of quick gains, poured their savings into these stocks, further driving up prices. Platforms like Robinhood democratized trading but also amplified speculative behavior, as inexperienced investors followed trends set by institutional players. The result was a feedback loop. Institutional buying pushed prices higher, attracting more retail investors, which in turn justified further institutional investment. This phenomenon is not new. During the dot-com bubble of the late 1990s, similar dynamics were at play. Companies with little to no revenue achieved astronomical valuations, fueled by speculative investments. When the bubble burst in 2000, trillions of dollars in market value were wiped out, leaving countless retail investors holding the bag. Today's big tech bubble bears eerie similarities, with valuations detached from underlying fundamentals. Political corruption and financial influence. The intertwining of big tech and political power further complicates the narrative. Stocks of these corporations have been used as a currency to influence policymakers. Donations, lobbying efforts, and other forms of political contributions ensure that legislation remains favorable to both big tech and the financial institutions backing them. For example, during the 2020 election cycle, big tech companies were among the largest contributors to political campaigns. Simultaneously, financial institutions like Goldman Sachs and J.P. Morgan maintained extensive lobbying efforts to shape regulatory frameworks. This collusion has created a system where the interests of a few outweigh the needs of the many, perpetuating economic inequality and eroding public trust. The ownership question. Who pulls the strings? At the heart of this system are the real power players, the families and entities that have historically controlled global finance. The Rothschilds, Rockefellers, and Morgans have long been associated with central banking and major financial institutions. While some dismiss these connections as conspiracy theories, historical evidence supports their outsized influence. The Rothschild family, for instance, played a pivotal role in establishing modern banking systems in Europe. The Rockefellers' Standard Oil empire laid the foundation for their financial dominance, while J.P. Morgan's banking empire was instrumental in shaping the U.S. financial system. Today, their legacies persist through holdings in institutions like the Federal Reserve and other central banks worldwide. These families' influence extends beyond finance. Through interlocking directorates and ownership stakes, they exert control over major corporations, think tanks, and policymaking bodies. For example, Vanguard and BlackRock, two of the largest asset managers, hold significant shares in nearly every major company, including big tech giants. Their combined influence shapes corporate strategies, market trends, and even government policies. A bubble ready to burst. The current trajectory of big tech and Wall Street is unsustainable. Sky-high valuations, fueled by artificial liquidity and speculative investments, are disconnected from economic realities. As interest rates rise and monetary tightening takes hold, the flow of easy money that has propped up these valuations will diminish. When the bubble bursts, the fallout could be catastrophic, reminiscent of the 2008 financial crisis or worse. Moreover, the concentration of wealth and power in the hands of a few exacerbates systemic risks. When financial institutions and political leaders prioritize short-term gains over long-term stability, the entire system becomes vulnerable. The collapse of a single major player could trigger a domino effect, destabilizing markets and economies worldwide. Conclusion: the exponential growth of big tech corporations on Wall Street is not merely a testament to innovation but a reflection of a grand scheme involving the Federal Reserve, financial institutions, and entrenched elites. By manipulating monetary policy, influencing political decisions, and leveraging public trust, these entities have created a precarious economic bubble. Understanding this hidden dynamic is crucial for addressing the systemic risks it poses and ensuring a more equitable and sustainable financial future.